Hello and welcome for another one of our webinars, a very timely webinar at that. First of all, I just want to say thank you to each and every one of you for taking time out of your day to be part of today's webinar presentation. I think it's going to be very informative and, as I said, very timely after all that's happened last week. Hopefully the email that I sent out to you on Thursday gave you some of our thoughts about what we were doing. And then again on Friday, Jason sent another email on some changes we made to the portfolios. As you know, we take advantage of the volatility in the marketplace to make changes that we think our clients will profit from. So before we go any further, without any further ado, let Jason Alonso and Paolo LaPietra introduce themselves so you know who's on the webinar today and who's presenting. Jason, go ahead.
Thanks, Steve. Hi, I'm Jason Alonso. For those that don't know me, I joined Steve and team last summer, focusing on the investment side, and I'm excited to be here today to discuss the current events in the marketplace.
And hi, everybody. My name is Paolo LaPietra. I am one of the wealth advisors along as portfolio strategist here at the firm. I am a certified financial planner and really looking forward to today's discussion.
Thank you, Jason. Jason and Paolo are a big part of my life. They really help me with the investment side. As you can see, Jason is a chief investment officer. Paolo wears two hats, wealth advisor and portfolio strategist. And together we come up with a lot of our ideas, research, and so forth. Jason brings a lot of experience to our firm, 21 years managing mutual funds in New York City for JP Morgan. So we're lucky to have Jason join our team last summer, and Paolo's been with me now for almost 5 years. And I'm telling you, folks, when I tell you that I'm surrounded by a team second to none, I have 16 professionals that really are part of the team that help bring all that we can bring to your life, your financial well-being, and so forth. So let's get started with the webinar because that's why you're here. Making sense in the market. We actually scheduled this before we woke up on Thursday morning to Russia invading Ukraine, and that's why I say it's really a timely webinar. Today, we're going to discuss market volatility in Ukraine, of course, equity market volatility, some changes that we've made in the portfolio and the economy. As you know, year to date, we're kind of taking a baby step backwards. If you look as of this morning, domestic large cap equity index is down almost 8%, the same with the S&P 500 index. That's down about 8%. Small caps are down about 9%. International developed stocks are down about 5%. Emerging markets down about 3%. US bond index down almost 4%. The commodity index up 13%. Jason and Paolo will get into some of the reasons why they're doing that. And as you know, we don't own any international holdings in our portfolio. We haven't in quite some time. And if you look, it's actually been a great move by us. So we're not all that concerned that, maybe emerging markets aren't losing as much as the S&P. We'll watch that. I'm not saying we won't get back into some emerging market or international developed stocks. We may down the road, but right now we're still holding on to just, for the most part, an exclusive USA portfolio. And before I hand it off to Jason and Paolo, there's 11 sectors that make up the S&P 500 index. As you can see all the way on the left, energy, to all the way on the right, consumer discretionary. We're very happy in a lot of ways, Jason and Paolo. We actually overweight energy and then we doubled down on energy. And as you can see, that's the #1 performing sector year to date. We took a little bit off the table. I'll let Paolo and Jason talk about that in their part of the presentation. Financials is the second best performing sector. And if you go all the way to the right, and I need to bring this up because we recently put this consumer discretionary in the portfolio, but we did that after it's been down. So this gives you an idea of how all the sectors of the S&P have performed year to date. So with that being said, I'd like to hand off the presentation to Jason and Paolo.
Thanks, Steve. Geopolitical tensions involving Russia and the Ukraine have been a source of market volatility, especially since February 11th, when President Biden warned there was a very distinct possibility of a coming Russian invasion of Ukraine. Well, first and foremost, our team here at Boucher has been horrified by the actions taken, and our hearts and prayers go out to everyone that's been affected by this terrible conflict. It's just another reminder of how lucky we are here in the United States to not have to worry about keeping our loved ones at home safe from live fighting. And although it's slightly uncomfortable to sit here and talk about investment returns and investment returns historically around geopolitical events, that's why we're here today. So without further delay, let's dig into some of that. Well, first, we took a look back at historical conflicts to get a gauge on how much damage could be done in the markets with this current conflict in the Ukraine. And we started with two great wars. First is World War I, where the Dow Jones returned to 88% in 2015. Admittedly, the market did have an initial decline in 2014. But from the start of the war in 2014 until the war ended in 2018, the Dow had gained 43%, which is roughly 8.8% annually. World War II had similar effect on equity markets. The day of the Pearl Harbor attack in 1941, stocks lost 3.8% that day, but it took less than a month to recover these losses. And over the course of the war from 1939 until it ended in 1945, the Dow gained 50%. Or 7.7% annually. So to wrap that little piece up, during the largest two conflicts in modern history, the United States stock market gained 115% during these two periods, which is pretty incredible. Similarly, the Cuban Missile Crisis, during this 2-week crisis in October of 1962, the market had an initial drawdown, but ended the year rallying 10% post the crisis. When the US invaded Iraq in 2003, stocks went on to rally 30% from the March levels of the invasion. So this is not to say that war is a good thing. And from a human perspective, it's clearly not. But from a market's perspective, they've shown that historically they take these events in strides and recover as the conflict gets resolved. We wanted to look here at 22 different geopolitical events to see the average drawdown in the market here was a drawdown of minus 4.6%, with it taking around 3 weeks for the market to bottom on average. Now, I'm not going to spend time on each event with you here. What we're trying to do is get a gauge of how much damage can be done in the market, then looking at historical events. And they say roughly 5% once the event occurs. And history has shown, as you see on this chart here, that these conflicts do arise from time to time and the market remains resilient. I think this is a pretty powerful chart showing a laundry list of global conflicts going back nearly a century. You know, importantly, though, the dark blue line, which represents the S&P 500 index, you can see steadily marching higher for the better part of the last century. Now, yes, there were dips in and around each conflict, but the two things that become clear from seeing this chart are, one, unfortunately, as global citizens, we've had to deal with many conflicts, and learning how to deal with and adapt to each conflict gives me comfort that we will get through this Ukrainian crisis. And two, the market has remained resilient around conflict. Any drawdowns we've suffered on this chart due to geopolitical conflict has eventually been recovered and then some. Speaking of market returns since corrections, where corrections are defined by a drawdown of 10% or more in the overall S&P 500 index, and looking at the last 33 instances where the market has fallen at least 10%, we can now look forward and see what the returns were following that correction. And on average, you can see circled here in the green line, the green circle. On average, the 1-year forward return after the correction was a gain of 24.8%. The average 2-year return after a correction, where again a correction is a drop of 10% or more in the S&P 500, the average return was a gain of 37.4%. And almost 90% of the times, the market was higher 1 and 2 years out post the correction. So the market had corrected 10% earlier this year. And as investors, we should be focusing more on having a better tomorrow than trying to fix yesterday. And using history as a guide, the forward returns using today as a starting point have turned out quite well for investors. From here, I'm going to turn it over to Paulo.
Thank you, Jason. So the next few slides, I'll be discussing market volatility from a historical perspective. So it's no surprise we've been experiencing equity market volatility for about 2 months now. And being an equity investor, it's important to understand that volatility comes with the territory. This graph here takes a look at the largest S&P 500 intra-year drawdown depicted in red versus the calendar year return, which is shown as the gray bar. If you look all the way to the right of the graph, we could see that equity investors have been somewhat spoiled with strong market returns and little volatility over the last 3 years. Now in 2020, we could see that there's a 34% pullback from COVID lockdown, but we need to remember that was a V-shaped recovery. Markets went on to make all-time highs that year. If we look all the way back to 1980, we could see that the average intra-year drop is about 14%, with the S&P being positive 32 out of the 42 years. So looking at the recent volatility from a historical perspective, the S&P 500 is only down roughly about 8% year to date, which is below the 42-year average, supporting that this recent volatility is right in line with the historical averages. Now that we understand that the average intra-year drawdown is 14%, it's equally important to understand how often these corrections happen and how long they last for. Taking a look at the graph to the left, we could see a decline of 10% or more happens every 16 months and will last roughly about 14 and a half months. This graph is important because equity investors often overlook the average length of volatility. Seeing that the average length of a 10% or more correction is 4.5 months suggests that we can continue to see volatility for the next couple of months, and that shouldn't cause any concern because it's right in line with historical averages. Taking a look at the graph to the right, this is looking at stock market losses going back to 1928. Here we could see a 10% or worse intra-year correction has happened 63% of the time, just further driving home the fact that what we're currently experiencing is nothing out of the ordinary. As we saw in the last 2 slides, the volatility we're experiencing is right in line with historical averages, but it may seem like the drivers of volatility are the real reason for concern for investors. We have geopolitical risk of Russia invading Ukraine, rising interest rates or inflation. All of these headlines are making this volatility feel different than times than before. This chart here does a great job of showing us all of the headlines that the markets have had to overcome over the years, going on to make new all-time highs again and again. So while the headwinds that we're facing now may seem pretty severe and a cause for panic, it's important to remember that they'll just end up being another red dot on this graph and a point where we'll pass eventually to make new all-time highs again. So the next few slides, I'll be discussing the changes we made over the last couple of months for the portfolio. The first move that we made in the portfolio was doubling our energy exposure in the 4th quarter of 2021. So with Russia's dominant market share of oil supply to Europe and the growing conflict in Ukraine, we saw continued upward pressures on oil prices. As of last Friday, we booked a 20% outperformance compared to the S&P 500, as we could see below. With the oil prices currently sitting at about $100 a barrel, we decided to take this opportunity to dial back our energy exposure and use the profits to buy into BITO and JEPI on Friday. Now, BITO is a Bitcoin ETF, and with Bitcoin under 40,000 in traditional financial markets under pressure due to the Russian economic sanctions, we found this to be a favorable entry point, which today's price action is supporting, with BITO up over 5.5% alone today. JEPI is the JP Morgan Equity Premium ETF, and as bonds continue to face headwinds through this rising rate and inflation environment, JEPI helps provide income by getting exposure to high dividend paying companies and using options to increase the cash flow while limiting the amount of volatility associated with the position. Our alternative sleeve has been a main driver of outperformance for the last 6 months. We've understood since the beginning of the middle of last year that bonds were under pressure due to rising rates and inflation. So we decided to introduce CBHIX, which is a Victory Capital Market Neutral Fund. And similar to JEPI, this gives us exposure to high dividend paying companies, but uses options to eliminate any market risk. Here we could see how CBHIX has outperformed against the ag, up over 3.5% since October, while the ag has been down over 4%. So as bonds continue to face this downward pressure, we're going to continue to add alternatives like CBHIX to provide income while still providing performance. And the last move I'd like to highlight is our recent additions of Apple and Amazon into the portfolio. So as many of you listening know, we traditionally utilize ETFs to achieve our investment exposure. However, if we see a buying opportunity for single stocks that we believe have good fundamentals and earnings, we'll add them to the portfolio. We feel like Apple and Amazon are uniquely positioned in the market right now, both having extremely strong balance sheets and earnings and diversified business strategies. So as we enter this rising rate environment, which we most likely will this year, earnings are going to become more and more important. Here you can see the performance difference of Apple and Amazon, who had extremely strong Q4 earnings, versus Netflix and Meta, who had weak Q4 earnings. Currently, Apple and Amazon are only in our tax-deferred accounts, but we're going to be looking to be putting both positions into our taxable accounts, as we feel that the current and long-term prospects for both look extremely promising. And I will pass it back off to Jason.
Thanks, Paulo. And as Paulo highlighted how earnings are important, it's worth noting that the fourth quarter earnings season wrapped up last week for the S&P 500, and it turned out to be a really strong quarter. You can see on the table on the left, I have earnings growth circled coming in north of 30% at 31.5% year over year, with revenue growth approaching 15% gain year over year. Looking at the graph over the right, these show the earnings growth numbers for the S&P in recent quarters, as well as estimates for future quarters. And I've circled in red the estimates for earnings growth for the next 4 quarters. The first thing you'll notice here is that the growth in earnings over the next 4 quarters is less than what we've experienced in 2021. As you see, the bars are not as tall as the ones that we saw in 2021. But so you'll notice that the earnings growth has slowed in 22. But importantly, each of these 4 quarters is expected to show positive earnings growth in the mid-single digits. Now, this helps alleviate concerns about a recession, with a recession being defined as 2 consecutive quarters of negative GDP growth. And based on estimates, that does not look likely here. And not having a recession is important because the S&P 500 has only had one bear market in the last 5 decades that was not caused by a recession, and that was the 1987 bear market. So a bear market, again, is defined as a 20% drawdown in the overall S&P 500 level. As you can see here on the right, 1987 was the only year that we had a bear market that was not caused by a recession. And again, that's why it's important to keep an eye on earnings, which again are forecasted, which are not forecasted for a recession. They're forecasted for growth in each of the 4 quarters in 2022. And the most recent data we have was the fourth quarter earnings numbers we saw last week were very strong, coming in north of 31%. So that should give us some comfort that recession is not on the horizon. Outside of geopolitical concerns, inflation and the acts of the Federal Reserve plan to take into raise inflation have been the biggest concerns in the market. This may surprise some, but economists expected inflation measured on a year-over-year basis to decelerate in 2022 as the year progresses. We just saw CPI, or consumer price inflation, for January at 7.5%. Which was the highest reading we've seen in that measure since the early 1980s. And now, to add on top of that, we have the conflict in the Ukraine adding additional inflationary pressures, particularly in the energy sector. But when economists were given 3 scenarios with oil, the oil price, here are the results that we see. You'll see on the purple line over here on the graph, the purple line depicts what happens if there's $120 a barrel oil. The orange line shows what happens with inflation if it stays in the $90 to $95 a barrel range, which was 95 in the most recent number I saw this morning. And then the blue line is, is I guess a little bit more pessimistic on the oil price if you're a bull, I guess. And that's good at the pumps though, but that's $75 a barrel, pretty unlikely. But what happens to inflation in all these scenarios? And what you'll see is the progression of inflation throughout 2022 with each of these assumptions for oil prices is for decelerating inflation, is that there's steady deceleration in year-over-year consumer price inflation. Yes, it does end the year somewhere in the 4 to 6% range, depending on which of these scenarios you believe. And yes, that's well above our 2% target that the 2% target that the Fed sets, and that the inflation we've seen in recent decades. But it is at least trending in the right direction. And this is important because of all the concerns that we've had about the Federal Reserve raising rates, and then the negative effects that would have on the equity market. The one, if there was anything positive that came out of the geopolitical conflict, is that it's pretty much taken off the table the idea that the Federal Reserve was going to raise rates 50 basis points during their March meeting. So a 25, I'd still believe they'll raise rates, but a 25 basis point hike is more likely. Additionally, as you'll see on the table here, in each of the last 8 times where the Federal Reserve has made the first rate hike of a cycle, the market has been positive 6% on average over the next 6 months. And on average, it's up over 9% over the next 12 months following the first rate hike, which is expected next month. So again, with market participants expecting the potential of up to 6 or 7 rate hikes this year, I feel that with decelerating inflation that is expected from economists throughout the year, as well as geopolitical events, this may give the Federal Reserve some leeway to hike rates less aggressively, which could provide a tailwind versus market expectations. But also, as you've seen what's happened at the onset of other rate hike cycles, the market has taken these well, adding 6 and 9% over the next 6 and 12 months historically. With that, I'm going to turn it over to Steve for some closing thoughts.
Thank you, Jason and Paulo. I think the presentation is really good information, and hopefully everybody that's tuned in will realize that we try our best to communicate as best we can. And I think that Paulo and Jason put together some data that just supports the fact that we feel the stock market will be up by the end of the year, not down. As Jason just said, we don't see a recession on the horizon. We're more bullish than bearish. And unfortunately, you go through some times where the headlines are just horrific. And right now, my heart just goes out to the people of Ukraine. I've gone to mass. I've said many prayers for them, for these people to be uprooted, hurt, or worse. It's just crazy. They have to flee their country to find safety and peace. And I'm just hoping that the people of Ukraine will come out of this in a good way sooner than later. And when I see what's going on this morning, we woke up where the Ukraine people are really holding Russia back. And that's really a testament to their character and just how passionate they are, that they're not going to let their country be overtaken. So we will get beyond these warlike times and back on normal. And as Jason and Paulo say, the fundamentals of the stock market, which is really what the stock market trades on the most, looks pretty good. As I sit here to close out today's webinar, the stock market has recovered over half of the loss from first thing this morning. And because we just added Bitcoin to the portfolios, Bitcoin is actually up almost 41,000. We brought in at around 38,000. And I know that was a unique holding that we added to the portfolio. I think Paulo described it well. But with that and all of the holdings that we have, if you ever have any questions, please feel free to call us, email us, reach out to us any way you can, any way that you want. And we'll be here to hopefully explain just what we're doing on your behalf to manage your wealth. I thank you for the trust you place in our. I am surrounded by, as I said at the beginning of the webinar, 16 very talented professionals who I think this is the best team that I've ever been surrounded by. And we're just getting stronger. And that means we're going to be able to do that much more for you. So hopefully we continue to meet your expectations. That's important. And I said just a moment ago, I'm going to say it again and repeat myself. Thank you for the trust that you place in our services. Jason, Paulo, thank you for the presentation today. I hope everybody stays healthy, stay well, and stay tuned for our next webinar, which will be coming up soon.